Hey everyone, Eric here. Today, I'm going to cover a finance case study about the strategy of one of the most contrarian and successful software businesses of all time, Constellation Software. I'm going to show you how they've been valuing and acquiring hundreds of tiny vertical market software businesses over the last 30 years for outrageously low multiples. This is one that you won't want to miss. Okay, let's get started. So let's talk about the background of this business for a moment. So first off, Constellation Software was founded by this guy named Mark Leonard. He was a VC in the 1990s. He's a very low profile person. I think he's only done like 1 or 2 interviews ever. And he was a VC in the vertical market software space. So these are B2B SaaS companies in niches. And he noticed, and obviously the VCs noticed, that these companies have great economics. So they require very little capital to grow, so almost no CapEx, 80 to 90% gross profit margins, very, very sticky, so incredible lock-in, low churn, high pricing power. But they don't always get really big. So as the VC, they're trying to invest in a company that's going to get to, $1 billion valuation plus. But what happened is that even the number one companies in the VMS space in a niche could be, cap out at a couple $1 million of revenue. And so some of these businesses were small despite having good economics. And the issue was that nobody wanted to buy a business doing $2 million in revenue at negative 3% growth. So sort of flat growth or even negative. So what he did is he started, after learning about these companies as a VC, he started buying vertical market SaaS businesses in 1995, but only with extremely specific requirements. And so here's what they did. We're going to model out the way that he started acquiring companies, and that's the way that they still do it today. So they're happy to buy flat or shrinking companies. Generally, they're not buying businesses that are growing very fast because those are businesses that other people want to buy, and they don't want any competition. And so they think there's like around 40,000 of these businesses, or maybe even more. And basically what Mark Leonard said was that if the business is doing under 1 million in revenue, our hurdle rate, so how much we need to make per year, needs to be a minimum of 30%. So basically what you do, let's say this business is doing $800,000 in revenue, right? $800,000. And let's say it's shrinking at 3% per year. So what they would do is they would go in and say, okay, what's the EBITDA? Maybe it's 184,000. What's the free cash flow? Probably a little under the EBITDA. So maybe 20% of revenue. So maybe 160,000 of free cash flow per year. And what they would do is say, okay, in order for us to make 30%, let's assume that the terminal growth rate is negative 3%. So this company is just going to shrink 3% per year in perpetuity. So in order to make 30%, you just take this out of your terminal growth calculation from your discounted cash flow model. You take your free cash flow estimate, and then you take your hurdle, and you subtract your terminal growth rate. So that's actually negative 3%. And what you get is what you can pay for this business if you want to make 30% per year, if it's shrinking 3% per year, and these are the free cash flow margins. So basically, you could pay $484,000 to buy this business and make 30% per year. And so the revenue multiple would be 0.6 times revenue. The EBITDA multiple would be 2.6, and the free cash flow multiple would be 3. So basically, nobody's trying to buy these businesses, or, at least back in the day, nobody was trying to buy them. So what Constellation Software did is they would just offer to buy these businesses at hurdle rates where they could hit between 20 and 30%, 30% for businesses under $1 million in revenue, 25% was their target for businesses for 1 to 4 million in revenue, and then 20% for over 4 million in revenue. And so they would enter into these deals, and they said they would only close 1 in 10 deals because they're they were so cheap. And most businesses would not accept these offers. And if they couldn't get it, for instance, if their target was 30%, if they couldn't get 30% hurdle, if it was at 29%, they wouldn't make an offer. And so they were extremely, extremely disciplined. And so they have basically just been doing this since 1995. So let me talk about the other types of deals, just so you can see sort of like the other segments. So if we just take the same model, their hurdle targets were 25% for deals that were 1 to 4 million. They said that that was like 90% of their deals were these small vertical market SaaS companies that weren't growing at all. And then over 4 million, 20%. And they've done some of these larger deals in the past few years, but they said they haven't needed to lower their hurdle targets any more than that. And so let's say for this business, let's say you have a $3 million business, your EBITDA margin, let's say it's 18%. And if you want to make 20%, we have to put in a growth rate here. So let's say this business is growing 5% a year. And that's going to be our terminal growth rate that we'll use here. So in this case, to make 25%, they could pay $2.25 million. And I know this is a very simplified version of the discounted cash flow model, but I'm just trying to demonstrate the type of math that they were using to acquire these businesses. Now, let's say you had a larger business. Let's say this business was doing $23 million a year in revenue. Let's say it was shrinking 6% per year, perpetuity, and their EBITDA margin was 37%. So for this business, because their margins are higher, if their hurdle's 20%, you see that you can pay 1.3 times revenue, 3.5 times EBITDA, and 3.8 times free cash flow. And they've reported that their average deal was actually 0.8 times revenue. So, most businesses won't accept these offers, but some will. One of the things is they have kind of a Berkshire Hathaway-like structure. So when they buy a business, they never sell it again. So once they buy you, you can just basically run the business inside of Constellation Software forever. It's decentralized. All the operators run their own businesses. And so there are some other kind of interesting things. So they're acquiring these businesses and these really cheap, uncompetitive deals. They have no earnings calls. They just basically publish a PDF on their website. It reminds me of this expression, which is that the whale only gets harpooned when it surfaces. Seems like they don't want to make a lot of noise because they don't want a lot of people copying them, although there are some copycats that have come out. And then the other few things they do, which are really interesting, is that they have no debt. They've never taken on really any debt, and they've never increased the share count. And so all of the free cash flow growth has been sort of, on a per share basis, just grows with the business. And they only buy businesses with their own free cash flow. So they just wait until they have enough free cash flow and then they buy businesses. And so they just do that over and over. They've been doing it for almost 30 years in a row. The other thing is that executives are required to invest 75% of their bonuses into common shares. So the executives are basically just incentivized to make the share price go up. So, no misalignment of incentives, and they're required to actually buy the shares with their own money. Interestingly, the organic growth, because they're buying all these flat businesses, it's usually somewhere between 2 and 6%, sometimes like 2-3% per year. So let's say our business grew 2%. And then we took all of our free cash flow and we just bought companies with it. And today they own over 500 companies. They're buying 100 plus companies per year. And they have been growing their revenue for like 25% a year for like almost 30 years in a row. So this is a super interesting strategy. Most people in SaaS want to, buy the fastest growing SaaS business. And you'll see, these businesses will get bought for very high multiples, 10, 20, 50, even in the top of the bubble, 100 times revenue multiples. And this guy is buying, hundreds and hundreds and hundreds of SaaS businesses for like less than 1 times revenue. But when you consolidate the whole conglomerate together, actually the whole business has really, really good margins. So I just want to show you kind of like what the revenue looks like today and the free cash flow looks like today, and how they're able to reinvest the free cash flow and how fast they can grow their revenue with the free cash flow that they're generating. One quick thing, if you're finding this content valuable, please give this video a thumbs up and don't forget to subscribe. Also, if you want me to teach you everything I know about finance for startups in a small group with personalized support from me, check out the link in the description below for a chance to join the next cohort of my training program, Finance for Startups. Okay, so let's just take a look here. And, this is a very unexact model. I don't work in private equity. I'm not a professional investor. This is just me kind of trying to figure out, okay, if they generate this amount of cash and these are kind of their rough multiples, how fast can they grow their revenue just with reinvesting their free cash flow? So here is basically what it kind of looks like. So this is their revenue over the last couple of years. So in 2020, it was $3.9 billion. And now it's scaled up to about $8.4 billion in 2023. So they're growing their revenue like 25-30% per year. You can see their gross profit margins here are like 88 to 90%. So very, very high. Their EBITDA margins are generally, 15 to 30%, kind of fluctuates from some of the accounting, but their free cash flow is usually in the 20s. It's like 20 to 25% of their revenue. They just convert it directly into cash because they have no debt. So this is where it gets interesting. So let's first look at how fast they're growing their revenue organically and then inorganically, meaning through acquisitions, and then how much revenue and free cash flow are they able to acquire with their free cash flow that they're kicking out. So I just wanted to kind of pull this forward for 6 years to just see like if they're able to maintain these types of multiples, like how much can they keep growing this thing? So their organic revenue growth, let's just say 3% average. It sort of fluctuates from like I said, 2 to 5%. And so what I said here was that if they're growing 3%, they'll add 250 million of organic revenue to their total. And if they're growing their free cash flow by 3%, let's just say they grow their free cash flow by 3% as well, that's 50 million. Now, let's talk about, this is where it gets interesting, the acquisition. So they kicked out 1.7 billion of free cash flow. And it's interesting because, they're buying, companies doing $1 million in revenue. So, you need to buy a lot of companies when you're doing 1.7 billion in free cash flow. But let's put in the revenue multiples that have been kind of reported. So 0.8 and their free cash flow multiple, let's say 4 times free cash flow. So here you can see they're probably doing a lot of these deals for less than 4 times, annual free cash flow. So this is kind of an imprecise way to think about it, but I was just curious. So if they have 1.7 billion of cash, basically that means that they can buy 2.1 billion of revenue. And they can buy about 434 million of additional free cash flow. So if you just kind of continue that forward, what you need to do here is you just take this and you add their sort of organic revenue plus their acquired revenue. And you can see that the growth rates are amazing. They continue to look like basically what they have looked like. So let me so you have your free cash flow. Here we go. So what you see is with this amount of free cash flow that they're kicking out every year, they're able to just grow 25 to 30%. And so, their multiples might vary to some extent, but, this is a business that they've been able to maintain these really low acquisition multiples, even through the kind of hot software market of the last couple of years. And, in an economic downturn, they're not using their own stock to acquire companies, they're using their cash. So they can probably acquire companies for even lower multiples in a bad economy because they're going to continue to generate probably similar free cash flow margins through any economic period. So it's just a very interesting business, and how exactly it works, I don't really know. I don't know how they're able to do this. Like I said, Mark Leonard keeps an extremely low profile. Most of the information about the company comes out from former employees, but it's just an example of a very different way to build a business that, these revenue and free cash flow margins might resemble one of these tech monopolies that built sort of similar economics through one giant business. but they were actually able to build very similar economics and competitive growth rates to these monopoly businesses by buying a bunch of tiny businesses. So very, very interesting and something to think about. By the way, if you know something more about Constellation Software, please let us know in the comments below so we can keep the conversation going. Okay, so I hope this finance case study helped you understand Constellation Software's unique capital allocation strategy. Also, if you found this content valuable, please give this video a like and subscribe to my channel. Thanks for watching, and I'll see you in the next video.